Welcome to the class. And I must first of all congratulate Priya for being selected as a trainee in a very well-known organization in Bangalore. So congratulations Priya, and our good wishes are there with you. And I'm very sure that you would be doing such fantastic work in this organization as you have been doing in your classes as well. And this particular, this starting would become a building block in your career, and you would be really doing very well in your career ahead. With this particular training, you would be able to learn a lot, and therefore, justify your time over there. But at the same time, don't get so engaged in your training that you do not get time to study. Now this is a very difficult balance that we have to maintain in our preparation for examination, as well as doing justice with our training, and it's a very difficult thing to do. So keep your terms very clear that you should get some time for your study as well, because whichever way you present yourself, that is how you would be taken up in your organization. That is one thing which I wanted to say to you on this particular day only. You would be starting from Monday, and so you have got some limited time before Monday to prepare for your training, as well as this time you can utilize for your studies as well. So our good wishes are there with you. Do very well. So, and where were we in the last class? We were discussing about LLP taxation. And along with LLP taxation, we also had started the discussion on alternate minimum tax, right? Any doubts, any questions, any queries with respect to that? I am sure you must have studied this concept, while you had this particular time of last 2 days. So any questions, any doubts? Well, just to give you a recap, in the last class we discussed what is a limited liability partnership. I discussed with you how a limited liability partnership is taxed, and I also discussed with you how partnerships are taxed. So we discussed that particular concept. We discussed how what is the limit of remuneration which can be given to the partners. We discussed the limits, like if the profit is up to rupees 3 lakhs, or if it is a loss, then you can pay maximum either 1,50,000 or 90% of the book profits, whichever is higher, and beyond that you can pay 60% of the book profits to the partners. We also discussed about the cap on the interest that can be paid to the partners, and we discussed one of the questions on the calculation, on the computation of income of the partnership. Thereafter, we discussed that what are the advantages and what are the disadvantages of becoming a limited liability partnership. I also gave you certain conditions. If they are fulfilled, those 6 conditions we discussed. And in those 6 conditions we said that if a private limited company is converted into a limited liability partnership, in that situation the transfer would not be considered as a transfer for the purpose of calculation of capital gain taxes if those 6 conditions are fulfilled. Now Sneha is asking a question that, ma'am, can a LLP be registered on stock exchange? The answer is simply a no. Only companies can register on stock exchanges, because companies can issue shares. LLPs cannot issue shares. So therefore, LLPs cannot be registered on a stock exchange, right? And thereafter we discussed about the concept of alternate minimum tax. I discussed with you section 115 JC of the Income Tax Act, and I told you that as per section 115 JC, if 18.5% of the adjusted total income is more than your tax that you have calculated, then in that situation the company would be required to pay alternate minimum. The LLP would be required to pay alternate minimum tax, which is equal to 18.5% of the adjusted total income plus surcharge plus education cess as applicable. And I also discussed with you that how do we calculate this adjusted total income, and I gave you the formula where I said that we'll start with the total income as per the computation of income of that particular limited liability partnership, and we will add to it the deductions claimed from section 80I to 80RRB, and we said except section 80P, we will also add to it all the deductions claimed under section 10AA and the deductions claimed under section 35AD of the Income Tax Act. Then we will reduce depreciation on the assets covered under section 35AD, and then we get the adjusted total income. So that is what we discussed in the last class. So far, any questions, any doubts, any queries, you can ask me. If not, then we would be today discussing some of the practical questions on calculation of alternate minimum tax. We would be discussing the questions which have been asked in the last examination as well. But before we do that, I must also tell you that every limited liability partnership is required to submit a report from a chartered accountant every year along with the return of income, where the computation of adjusted total income and the computation of alternate minimum tax should be shown, and the chartered accountant has to certify that the computation is correct, right? So this report has to be submitted along with the return of income. Now, in case, as I discussed with you in the last class also, in case your AMT is more than your regular tax, in that situation the company would be required to pay AMT. But in that situation, if the company is paying more tax because of AMT, whatever is excess can be carried forward for a period of next 10 consecutive years, and in these 10 years the LLP can claim the set-off of this tax credit which it has paid in this particular year. So that was what we discussed in the last class. When we talk about tax credit, like I told you that if the AMT amount is more and the regular tax is less, then whatever is the excess that can be taken over, that can be considered as tax credit. For the next 10 consecutive assessment years, you can utilize that credit in order to pay your regular tax also. But what are the conditions for that? First of all, you have to claim this tax credit within a period of next 10 consecutive assessment years. If this tax credit is not claimed in next 10 assessment years, it shall lapse. Secondly, you would not be getting any interest on this tax credit. You would not be getting any interest on this tax credit. Thirdly, in case of any kind of reassessment, appeals, or any kind of revisions in your income tax statement, like once you have submitted the income tax return, thereafter there was a reassessment or there was an assessment, and because of that, if the tax liability is either increased or it is reduced, in that situation your AMT credit will also accordingly increase or reduce, isn't it? So if the AMT credit gets increased or reduced, then that changed amount would be carried forward, right? Whatever is the amended amount, that will be carried forward, and you would be able to utilize the credit only in those years where your regular tax is more than AMT, and you would be able to utilize it only up to the differential amount. So that means that you have to pay the minimum, and beyond the minimum you can utilize the credit. Now those were the conditions. Now there was a question that came in, I think, June 2015 examination, which said the provisions of AMT are applicable to all assessees other than companies. Examine the statement in context of the provisions contained in the Income Tax Act relevant to the previous year ended 31st March 2016. Now, this particular statement is, just one second. Yeah. So the statement says that the provisions of alternate minimum tax are applicable to all assessees other than companies. To the companies, the provisions which are applicable are minimum alternate tax. So when we talk about all assessees other than companies, that includes individuals, that includes HUFs, that includes body of individuals, that includes association of persons, that includes cooperative societies, that includes partnerships, and that includes limited liability partnerships, right? So when we say that the provisions of AMT are applicable to all assessees, the answer is yes. Why it is yes? That it is definitely applicable to it is definitely applicable to limited liability partnerships, but with respect to other assessees. With respect to other assessees like individual, HUF, association of persons, body of individuals, or any other artificial judicial person, the provisions would be applicable only if the adjusted total income of such person exceeds rupees 20 lakhs. So there is a condition. So it is applicable to all assessees subject to the condition that the adjusted total income of that particular assessee is more than rupees 20 lakhs, right? So the answer is the provisions of AMT are applicable to all persons claiming profit-linked deductions, because it would become applicable only if you are claiming any profit-linked deduction or you are claiming any deduction under section 35AD, because otherwise you would not even get, because otherwise your AMT would be same as your regular tax, right? So any person who is claiming any deduction under section 80IA to 80RRB except section 80P, or under section 10AA, or under section 35AD, and its adjusted total income is more than rupees 20 lakhs, in that situation the provisions of AMT would be applicable. The statement can be viewed as correct since AMT applies to all assessees other than companies, but it can be considered as incorrect because AMT is not applicable to all assessees per se, but only to those assessees who have got profit-linked, who are claiming profit-linked deductions. So in these kinds of questions, the answer, whether it is true or false or correct or incorrect is not only sufficient, your reasoning beyond, your reasoning under it is very important. When you say the statement is correct, you would say that yes, it is applicable on all assessees but subject to the condition. When you say it is incorrect, you would say that it is applicable only in the condition where, only in those conditions where the assessee has got profit-linked, assessee is claiming profit-linked deductions, and also where the assessee has an income, has an adjusted total income of more than rupees 20 lakhs, right? So is the point clear? So therefore in these kind of questions it is like you can write it either ways. The next question that I have to discuss with you is a very interesting question. Just one second. ABC LLP, a limited liability partnership in India, is engaged in development of software and providing IT-enabled services through 2 units, one of which is located in a notified special economic zone in Chennai and commenced from 1st of April 2011. The particulars relating to previous year 15-16 furnished by the assessee are as follows. Now you have been told that there is a LLP, and this LLP is engaged in software and IT-enabled services, but it is working through 2 units. One unit is in SEZ, another unit is not in SEZ, right? So when it is one LLP working under 2 units, then we are going to club the profits, or you are going to club the incomes of the 2 units under the head profits and gains of business and profession. Now this says that you can claim the deduction of SEZ. That details have been given to us. Total turnover of SEZ unit is 120 lakhs and the other unit is 100 lakhs. Export turnover of SEZ unit is 100 lakhs and the other unit is 60 lakhs. Profit of SEZ unit is 48 lakhs and the other unit is 42 lakhs. The assessee has no other income during the year. Compute the tax payable by ABC LLP for the assessment year 16-17. Will the amount of tax payable change if ABC LLP is an overseas entity? Now you've got 2 questions to answer and you have to do the computation of the taxable income and the tax liability of ABC LLP. Now before I go further, can you tell me that if a unit is a special, if a particular LLP has got a unit in special economic zone, does it get any benefit, any profit linked incentive? If a particular LLP has got a unit in special economic zone, can it claim any profit linked incentive? Yes or no? Yes. Okay. Under which section? Yes, Neha? Tilaka? Yes. Under which section can this particular SEZ unit claim profit-linked deduction? Loss can be compensated. I don't understand this. I'm saying that which is the section which talks about the incentive to special economic zones. It's a very important section for your examination, and it is advisable that the student should be familiar with this particular section. This is section 10AA. Section 10AA. Section 10AA, what does it say? Section 10AA says that if you have a unit in special economic zone and the unit is established after 1st of April 2011, in that situation, for the first 5 years, you would not be liable to pay tax on 100% of your export profits. So how do I find out export profits? So in order to find out the export profits, you write total profits or the total income multiplied by export turnover divided by total turnover, so that you know that out of your total, see, you had a total turnover, you are a unit in special economic zone, and special economic zones are promoted for export promotion, right? So all incentives are given for export promotion, but it may also happen that the units in special economic zones, they start selling goods in the domestic tariff area. In that situation, we cannot give them the benefit of tax deduction. So what we have to do, we have to proportionately find out what is the proportion of export turnover to total turnover, and accordingly we have to split the profits into the export profits and the domestic profits. And whatever are your export profits, for the first 5 years you get 100% exemption, and then for the next 5 years, so for the first 5 years, what you get? You get 100% exemption under section 10AA. Then in the next 5 years, you get 50% exemption, and then in the next 5 years, you get 30% exemption from the payment of taxes on export profits. And this 50% and 30% is subject to the condition that these profits are reinvested in the business. They're not distributed as dividends, right? So this is section 10AA of the Income Tax Act. Any questions on this? Is the incentive clear to everybody? No questions, okay. So what I was trying to say in this particular question, if you look at this question, you would see that this particular LLP has got one division in special economic zone. Right? Has got one division in special economic zone, so it can claim the deduction under section 10AA. Right? It can claim the deduction. Now, Tilaka is asking, if loss occurred in SEZ unit, will it be claimed from other unit which is not SEZ? If there is a loss in SEZ unit, now this is one thing, okay. First is, it is the choice of the assessee whether it wants to claim the deduction under section 10AA or not. If you want to set off the loss from the other unit, in that situation you would not be able to claim the deduction in the next assessment years. So if you choose to set it off from the other unit, in that situation you choose not to continue with the benefits under section 10AA. Is it clear? So it's completely the choice of the assessee whether it wants to claim it or not. Now we go back to the question. So in this question, what we have to do, I hope I'm audible clearly. Okay. In this question, we have to first find out the total tax liability as per the Income Tax Act. So in order to do that, what we do, we write computation of total income and tax liability of ABC LLP as per normal provisions of the Income Tax Act for assessment year 16-17. We write particulars and we write rupees in lakhs. Now what we do, before giving any deduction, what is the business income? We will add the two incomes. We have been given two incomes. What are these? We have been told that it has got the profit from SEZ unit of rupees 48 lakhs. It has got a profit from SEZ unit of rupees 48 lakhs and the profit from other unit of rupees 42 lakhs. So first of all, what we have to do, and it has got no other income during the year. So first of all, we will add the two profits. So the total profit becomes the profit of 90 lakh rupees, right? Now we have to give the deduction under section 10AA. In order to give the deduction under section 10AA, what we have to write? We have to write profits from the SEZ unit multiplied by the export turnover divided by the total turnover, right? So profit from SEZ unit has been given to us as 48 lakhs. Total turnover of SEZ unit is 120 lakhs. Export turnover of SEZ unit is 100 lakhs. So how do we find out the incentive under section 10AA? 48 lakhs multiplied by 100 lakhs divided by 120 lakhs. Is it clear? Right? So we find out what is the incentive that he is getting. He is getting the incentive of 40 lakh rupees. So his total income as per the provisions of Income Tax Act is 50 lakhs. On this 50 lakhs, we compute his tax liability. Because it is an LLP, so the rate of tax is 30%. So 30% of 15 lakhs is 50 lakhs is 15 lakhs. We charge education cess and secondary and higher education cess of 2% and 1%. That makes it 0.45, and the total tax liability as per normal provisions of Income Tax Act is 15,45,000. Is it clear? Is it clear up to this part? Now we have to find out his total liability under alternate minimum tax. Any questions? Okay. So now we have to find out his total tax liability under alternate minimum tax. So in order to calculate his total tax liability under alternate minimum tax, what we have to do? We have to pick up this total income, right? Of rupees 50 lakhs. To this, what we are going to do? We are going to add all deductions that he has claimed under section 80IA to 80RRB. No deduction has been claimed. We have to add the deductions under section 10AA. So we have to add this 40 lakhs here, right? This 40 lakhs we will add, and we also have to add the deductions under section 35AD, which is not here. So 50 plus 40 makes it 90 lakhs. 50 plus 40 again makes it 90 lakhs, which is his adjusted total income. Now we have to find out alternate minimum tax on adjusted total income at the rate of 18.5%. That makes it 16.65. Charge education cess and secondary and higher education cess on this. So that makes the alternate minimum tax as per section 115 JC to be 17.1495. Right? Now compare the 17.1495 with 15.45 and pay whichever is higher. So 17.1495 is higher, right? 17.1495 is higher. So we would be liable in this particular case. ABC LLP would be required to pay alternate minimum tax because alternate minimum tax is higher. So since the tax payable as per the normal provisions of the Act is less than the alternate minimum tax payable, the adjusted total income shall be deemed to be the total income of ABC LLP, and the tax payable for assessment year 16-17 shall be 17.1495 lakh. However, ABC LLP can claim a tax credit of 1.6995 lakhs. Why 1.6995 lakhs? Because this is the difference between the normal tax and the alternate minimum tax. right? And this 1.6995 can be carried, 1.6995 lakhs can be carried forward for the next 10 assessment years, right? Now the second part of the question was that will these provisions of alternate minimum tax be applicable if it would have been an overseas LLP, if this LLP would have been incorporated outside India? In that situation also, if it would have been, if whether these provisions would be applicable, the answer is yes. The provisions of alternate minimum tax would also be applicable on overseas LLP. So even if it would have been an overseas entity, then also the alternate minimum tax provisions would be applicable. You would say that, ma'am, how would it be applicable? It would be applicable if it has got a permanent establishment in India. If it has got, because then only it would be required to pay tax in India. So if this LLP would have a permanent establishment in India, then it would be required to pay tax in India. And when we calculate its tax liability in India, we would be calculating both the normal tax as well as the alternate minimum tax. Is the point clear? Is the question clear? Can I move to the next question? Okay. One more question is there in front of you. This is a slightly, slightly advanced level of question, though not very difficult. It is again a very simple question. Victory Polyfibers, a partnership firm. Now, AMT provisions are applicable not only on LLCs but also on partnerships and other business assessees and other assessees also. So, Victory Polyfibers, a partnership firm, has earned a gross total income of rupees 300 lakhs for the year ended 31st March 2016. So, it has got a gross total income of 300 lakhs. The firm has not undertaken any international transaction or specified domestic transaction during the said year. The above includes a profit of rupees 220 lakhs from an industrial undertaking having a turnover of rupees 80 crores. This is the 5th year and the deduction under section 80IA of the Income Tax Act is available to the extent of rupees 200 lakhs. Now this deduction, now here the question is not of section 10AA. The deduction that the partnership is claiming is under section 80IA. 80IA deduction should also be clear to you as it is a very important deduction. Though, these deductions I am explaining to you, but this year in the budget we are expecting that most of the deductions would go away. But still, because it is relevant for your examination, so we have to discuss them. Maybe that over a period of time in phased manner, all these incentives would be taken back by the government. The government the finance minister last year only announced that these incentives are going to be taken back in a phased manner, but still, because it is applicable for your examination and it would be applicable for the next couple of years to go, so therefore we have to study these deductions and exemptions. So what I'm trying to say is, what is section 80IA? Section 80IA is similar to section 10AA. 10AA was for export promotion and SEZ. 80IA is simply for promotion of industrial undertakings. So if you start a new industrial undertaking, in that situation, for the first 5 years, you can claim the deduction of 100% of the profits from that particular new industrial undertaking. In the next 5 years, you can claim 50% of the deduction. I'm not sure whether this 30% is applicable under section 80IA or not. So what I think is it is for the first 10 years only. You can claim the deduction under section 80IA. There is no basic formula of total profits multiplied by export turnover and total turnover, because this is the profits that are coming from the industrial undertaking that are going to be exempt, that are going to be deducted under section 80IA, and therefore you don't have to do any that kind of a computation, right? So the question says that the above profit includes a profit of rupees 220 lakhs from an industrial undertaking having a turnover of 80 crores, right? This is the 5th year and the deduction under section 80IA of the Income Tax Act is available to the extent of rupees 200 lakhs. So they are very clearly written that out of these 220 lakhs of the profits, only 200 lakhs is eligible for deduction under section 80IA. So out of 300 lakhs of total profits, 200 lakhs is deductible under section 80IA. Is the question clear? The partnership firm has got a gross total income of 300 lakhs, out of which 220 lakhs is from a new industrial undertaking. But out of 220 lakhs, 200 lakhs is eligible for deduction under section 80IA. So we can say that out of 300 lakhs, 200 lakhs is eligible for deduction. There are some grey areas in the taxation workings, and hence the assessee is contemplating to file the return of income on 7th of December 2016 after seeking clarification from tax experts. Advise the assessee. Now, before we go further, I must also tell you that this deduction under section 80IA can be claimed only when you file your return of income before the specified deadline date. Before the specified deadline date, if you file your return of income, then only you can claim the deduction under section 80IA. I was also thinking that why this particular statement has been made, the firm has not undertaken any international transaction or specified domestic transaction, because if the firm undertakes any international transaction or specified domestic transaction, in that situation it is subjected to tax audit, to transfer pricing audit, and the last date of submission of return of income in that particular case is 30th of November of every year. Now, this particular firm has not taken any international transaction, so the last date of submitting the return of income for this particular assessee, because it has got a total turnover of more than rupees 80 crores, so that means that this partnership firm is required to get its books of accounts audited by a tax auditor, and therefore the last date of submitting the return of income for this assessee would be 31st of October, right? I hope you know the last date of submitting the return of income. In case of assessees who are required to go for tax audit, the last date of submitting return of income is 31st of October. In case you are required to go for transfer pricing audit, in that situation the last date of submitting the return of income is 30th of November. And in case you are not required to go for any of these audits, in that situation the last date of submitting the return of income is 31st of July. Right? So in this particular case, the last date would be 30th of I think it's 30th of September or 31st of October. It should be, just one second, I'll check. Maybe that it's October, yeah? 30th of September. No, it's not October. It's 30th of September. It's my mistake. So the last date of submitting the return of income is not October. It's generally extended by October. It's generally extended for a month, but the original date is 30th of September, right? So the last date of submitting the return of income is 30th of September. Advise the assessee firm by working out the total income and tax payable where the return is filed on 30th of September or when the same is filed on 7th of December. What is the practical solution as regards obtaining clarifications which might or might not have an impact on the total income? Now, the question says that the assessee is contemplating to file the return of income a little late, but if the assessee files a return of income late, in that situation it would not be able to claim the deduction under section 80IA. And what is the practical solution? That is what we have to find out, so that we are able to get the clarifications also, and we are not liable to increase our tax liability. We should be able to get the deduction under section 80IB as well. So as per section 80AC, while computing the total income of the assessee for a previous year, relevant to the assessment year 2016-17 in this case, any deduction is admissible inter alia under section 80IA. Such deduction shall not be allowed unless the assessee furnishes the return of income for the assessment year on or before the due date which has been specified under section 139 subsection 1. Now, if you look at section 139 subsection 1, it says that the assessees who are having turnover more than rupees 1 crore are required to go for a tax audit under section 44AB. And if the assessee would be required to go for tax audit under section 44AB, in that situation, the assessee can file the return up to 30th of September 2016. up to 30th of September 2016. Now let us look at the situation. If the assessee files a return of income on 30th of September 2016, then its gross total income is given to us as 300 lakhs. It can claim deduction under section 80IA because it has submitted the return of income on or before 30th of September 2016 of rupees 200 lakhs. So the total income, taxable income, would be 100 lakhs. On this 100 lakhs, we would be calculating the tax liability at the rate of 30% because it's a partnership. And then we charge education cess and secondary and higher education cess of 3%. So the regular income tax payable would be 30.90 lakhs. Right? Let us also do the computation of alternate minimum tax. Now the total income is 100 lakhs. To this we are going to add the deduction under section 80IA, that is rupees 200 lakhs. So the adjusted total income becomes 300 lakhs. There is no other deduction under 10AA. There is no other deduction under any other sections like 35AD, etc., etc. On this 300 lakhs, we calculate 18.5%. That is equals to 55.5 lakhs. Now, because the income is 300 lakhs, which is more than rupees 1 crore, in this situation, there is a surcharge at the rate of 12% because the adjusted total income is more than rupees 1 crore. So we calculate surcharge at the rate of 12%. It is equals to 6.66. You would say that, ma'am, why didn't we calculate surcharge in case of normal income tax? Because in case of normal income tax, the amount of total income was rupees 1 crore. Had it been 1 rupee more than rupees 1 crore, then we would have calculated surcharge. But because it is up to 1 crore, there is no surcharge. So that is why we did not calculate surcharge in that case. So we will add surcharge at the rate of 12% on alternate minimum tax because the adjusted total income is more than rupees 1 crore. And then we add the education cess and secondary and higher education cess. So we get the AMT as 64.02. Normal tax was 30.09. AMT is 64.02. We have to pay whichever is higher. So we pay alternate minimum tax and we would be able to get the credit of the difference between 64.02 and 30.09 if the return is paid, is deposited, if the return is filed on 30th of September. Right? Any doubts up to this point? Is it okay? Now, if the assessee does not file the return of income in time, if the assessee, now this is a tax credit of 33.12, right, which can be carried forward for the next 10 assessment years. But if the assessee does not file the return of income on 30th of September and files its return of income on 7th of December 2016, in that situation, it would not be able to claim the deduction under section 80IA. So it would be required to pay tax on full 300 lakhs. So we will calculate 30% of 300 lakhs, that is 90 lakhs. We will add surcharge because now the income is more than rupees 1 crore. So surcharge at the rate of 12%. And on that we will also calculate the education cess. Education cess is calculated on tax plus surcharge. Right? So his tax liability will increase from the alternate minimum tax of 66 lakhs to 103.824 lakhs. Right? So if it does not file the return of income in time, the tax liability increases substantially. Right? So what is the alternative that we can suggest to this particular assessee? We can tell him, see, the practical solution is that you submit your return of income in time, and then, if after getting the clarifications you feel that the return has gone and there were certain deductions or there were certain expenses that you had to claim which you've not been able to claim, you can file a revised return. Because if the return is submitted in time, you can file the revised return as many times as you want till the date of assessment or till 1 year from the end of the assessment year. Right? So it can file the return up to it can file the revised return up to 31st of March 2018. So in this particular case, what we can what we can suggest the assessee is that it should first file its return of income under section 139 subsection 1, that is called the original return, under in time, and thereafter when it gets the clarifications from the tax experts, if required, it can file a revised return under section 139 subsection 5, and this can be filed up from 1 year from the end of the assessment year 2015-16, right? So it can go up to 31st of March 2018. So, and once you submit the return in time, then only you can submit the revised return. If you file a belated return, you cannot even revise it. So therefore, we suggest that and because its tax liability is getting reduced from 101.97 lakhs to 62.88 lakhs, and it would be able to, like, if it deposits 62.88 lakhs as alternate minimum tax, it would able to claim the tax credit of 31.98 lakhs as well. So therefore, the firm is advised to file its return of income by 30th of September 2016. Is it clear? Is it clear? Is the point clear? So are you ready to take up one more question? And this is a very simple question. I think this you should keep it for your self-study. It's telling me, it's asking us to calculate the maximum amount of remuneration that can be paid to the partners. I think I would not be taking it up in the class. This is for your self-study. I'm going to the next question here. These are the two questions that were asked in the last examination in the old syllabus. So 10 marks question coming from alternate minimum tax. What are these questions? One question was, explain the provisions of charging alternate minimum tax and its rationale. So you can give the provisions that section 115 JC deals with alternate minimum tax, and the provision says that if 18.5% of the adjusted total income is more than your normal income tax liability, in that situation the adjusted total income will be deemed to be the total income, and in that situation 18.5% of the adjusted total income would be required to be paid as alternate minimum tax. Then you can claim the tax credit, and then you can also give the that how do we calculate the adjusted total income. And in its rationale, you can say that because there are assessees who are claiming profit linked deductions and not paying taxes to the government, so the rationale is to check the misuse of the profit linked deductions, right? So that is, and again you can give a rationale that there was a time when the private limited companies were getting converted into limited liability partnerships because because they wanted to avoid paying the minimum alternate tax. So in order to counteract that kind of a situation also, alternate minimum tax was brought in, right? So that is how, if for a 5-mark question, you've got a lot of material to satisfy the examiner. Coming to the next question, it says Rajan has an income of rupees 65 lakh computed under the head profits and gains from business or profession during the previous year 14-15. One of his business is eligible for claiming deduction at the rate of 100% of profits under section 80IB. The computed profit from such business is rupees 30 lakhs. Compute the tax payable by Rajan, assuming that he has no other income during the previous year 14-15 relevant to the assessment year 15-16. Now it's a simple question. You would say that, ma'am, how are you bringing it in alternate minimum tax? I am bringing it in alternate minimum tax because though it is a case of an individual assessee, but in case of individual assessees also, you've got income more than rupees 20 lakhs. If they are claiming profit linked deductions, they fall under the purview of alternate minimum tax. Is the point clear? And therefore, in this particular question, can I solve this question? Should I try to solve this question for you? Okay, you can just note down the figures. It has got an income of 65 lakhs under the head profits and gains of business and profession, and deduction under section 80IB of 30 lakhs. It's a very simple question. 5 mark, I think these kinds of questions really add value to the students because they can score full out of full marks. So how will you solve it? You will first write computation of tax payable by Mr. Rajan for the assessment year, the year applicable was 2015-16, right? And then you will write particulars, and here you will write amount. You will make a table. This format I have been suggesting for a very long period of time. So what you will write here, you will write that profits and gains of business and profession. Profits and gains of business and profession is, what is the amount? You have got an income of 65 lakhs. Okay. So the amount would be it has got no other income, so we can simply write deduction under section 80IA. What was the amount? It was rupees 30 lakhs. So the total income is 35 lakhs, right? On this 35 lakhs, you can calculate the tax liability. Because he is an individual, so he would be taxed under the slab system. So on first 2.5 lakhs, he would not be required to pay any taxes, right? So first 2.5 lakhs, 0. Then on the next 5 lakhs, on the next 2.5 lakhs, he has to pay 10%, so that becomes 25,000 rupees. Then on next 5 lakhs, he has to pay 20%, that becomes 1 lakh rupee. So then we have above 10 lakhs, we have got the income of how much? 25 lakhs. So on the balance 25 lakhs, he has to pay 30%. So 30% of 25 lakhs would be 7,50,000. Right? Now he would be also required to pay education cess, no surcharge, because the total income is less than rupees 1 crore. So on 8.75 lakhs, he would pay education cess at the rate of 2%. That would be 17,500, and there would be a secondary and higher education cess at the rate of 1%. That would be rupees 8,750, right? So that is his total tax liability. It is coming as 9,01,250. Now let us calculate his alternate minimum tax, right? So in order to calculate now we will write calculation of alternate minimum tax of Mr. Rajan for the assessment year 2015-16, right? And you will start with what? You will start with his total income. Total income is rupees 35 lakhs. What are you going to add to it? Add the deductions under section 80IA, that is rupees 30 lakhs. So the adjusted total income will be rupees 65 lakhs. On this adjusted total income, you can calculate alternate minimum tax. I'll have to scroll through just a second. You will calculate alternate minimum tax at the rate of 18.5%, right? I think the visibility is poor here. You can calculate 18.5% as alternate minimum tax. It would be coming as, I'll just write here, AMT would be 18.5% of 65 lakhs would be 12 lakhs 2,500. And on that you will calculate the education cess and secondary and higher education cess. So after cesses, the amount is coming as 12 lakhs 38,575. Now we will say that because the AMT is more than the normal tax, so therefore Mr. Rajan is required to pay 12,38,575. However, he can claim a tax credit of 3,37,000 rupees. Right? So that's how you had to solve this question. It is not a very difficult question, as I was saying. Is the question clear? Is the solution clear to everybody? It's not a very difficult question, but in the examination, at times, you're not able to understand how do we handle this kind of a question. You don't think about the alternate minimum tax because it is nowhere written in the question. Because it is nowhere written in the question that you have to calculate alternate minimum tax, so at times you forget to do that. And that is why I generally suggest to all my students that when you go in the examination, please be calm. Please try to, don't be impatient and don't be tensed, because if you would be tense, you would not be able to think on these lines. So when you read a question, read it twice and try to understand what is that the examiner wants me to do in this particular question. Why he has given me this information under section 80IB and why he has given me, the individual taxation, right? So that's what, and that too in the old syllabus. In the old syllabus, we generally say the taxation of individual is not in syllabus. It is the corporate taxation which is in the syllabus. But in order to check your understanding of alternate minimum tax, this kind of a question has been given in the examination. So got my point? Now, this is all that I wanted to discuss with you about LLP taxation. Anything that you want to discuss, you want to ask, you can ask. Otherwise, I'll start with taxation of companies. Any doubts, any questions, any queries? Till the time I'm uploading the file, you can definitely do that. It will take a couple of minutes before I finally get the PPT. Yeah, oh, it's so fast. I've got it right away. Yeah. So in the meanwhile, if you want to ask, so we have finished with now limited liability partnership taxation and we are starting with companies under Income Tax Act. Can we start this? Okay. So now I think I'm already through with the basics concepts which I'm going to ask you in the first exam preparatory. And the first exam preparatory is after 10 days, that is on 30th of January. Those students who have registered for exam preparatory, they may start preparing about LLP and all this taxation. So that would be the first, I think the first topic in the exam preparatory. And I want you to be thoroughly prepared. You've got 10 days to prepare. That is good enough time for the preparation sake, right? Now starting with the new topic, which is companies under Income Tax Act. Again, a very important topic, precisely more important for the old syllabus students, though I'm not saying that it is not important for the new syllabus students, but in the new syllabus, they've got so much to ask. So there would be a 5-mark question from companies under Income Tax Act. But in the old syllabus, we generally expect, more than 5-mark questions coming from this particular chapter. What are we going to discuss in this particular topic? First of all, if I'm going to discuss what is the taxation of a company, I must try to understand what is the definition of company which is given under the Income Tax Act. Company has been defined under the Companies Act, definitely yes. But it has also been defined under the Income Tax Act because the definition under the Income Tax Act is far wider than the definition which has been given in the Companies Act. So what is the definition which has been given in the Income Tax Act? Income Tax Act says that a company would not only mean an Indian company, but also a company which is incorporated outside India. Because if a company is incorporated outside India, then also we can tax it in India if it has got certain income which has been received in India, or if it has got certain income which is accruing in India or deemed to accrue or arise in India. And secondly, if it has got a permanent establishment in India, then we tax it in India. So therefore, we should know that it is not only the Indian company which comes under the purview of the Income Tax Act, but also any body corporate which is incorporated by or under the laws of any country outside India. Okay. Thirdly, Income Tax Act came into existence in 1961, and before that we had got Indian Income Tax Act of 1922. So in case there were certain entities, certain associations, certain institutions which were assessed as companies under the Indian Income Tax Act of 1922, they would continue to be assessed as companies under the Income Tax Act 1961 as well. Right? So this is something which we are, taking over from the previous act. Fourthly, in case there are certain institutions, associations or bodies which are not companies, but the CBDT has given an order that they should be assessed as companies. In that situation, those institutions, associations or bodies will be assessed as companies. Right? So the definition of company is clear. It is not only Indian companies but also companies incorporated outside India, any institutions which were considered as companies in 1922 Act, and any institutions which have been declared by CBDT order to be assessed as companies, they would be considered as companies under Section 2, subsection 17 of the Income Tax Act 1961. Now, when I discuss with you about companies, I would be discussing about various categorization of companies which have been done under the Income Tax Act. One is from the point of view of whether it is listed or not. Generally we call it like that, but the definition gives me a bigger and wider meaning than the listed or not. So we can say that a listed company is a widely held company because it is a company in which public is substantially interested. Because public money is put in that particular company. That company is called a widely held company. You would say that, ma'am, why the public money is invested only in the widely held companies? Because there are certain companies which are not listed. There are certain companies which are not listed, but still, these companies are the companies in which government has invested their money. So if government has invested the money in a particular company, even though it is not a listed company, still public is substantially interested. So that kind of a company should also be called a widely held company. That should also be called a widely held company. Then you would say that, ma'am, further there are certain companies which are subsidiaries of widely held companies. So indirectly, it is the public money which is invested in that company. So therefore, those companies should also be called widely held companies. I would say yes, those companies would also be called widely held companies. So what are closely held companies? Closely held companies are those companies which are not widely held companies. You would also say that, ma'am, okay, there might be certain companies in which have not listed the shares in the stock exchange, but they might have collected public money through chit funds, or they might have collected public money through Nidhi scheme, like the Sahara Group kind of companies. They are not listed on stock exchange, but a lot of public money is there with them. So those companies should also be called widely held company. I would say yes, those companies are also treated as the widely held companies. Those companies are also treated as the widely held companies, right? So what are widely held companies? I'll just give you the definition. Widely held companies are those companies, just a second. Widely held companies are those companies in which minimum 40% shares are held by or owned by the government or by the Reserve Bank of India. All Section 25 companies which are formed, or in the latest Companies Act, all Section 8 companies which are no profit, no loss making company made for charitable purposes, they should also be considered as widely held companies. Companies which do not have any share capital But if they are declared by CBDT to be companies in which public are substantially interested for any particular assessment year, they would also be called widely held companies. Companies whose principal business is acceptance of public deposits, or it's a Nidhi company or a mutual benefit society, that would also be called a widely held company. Company whose shares are shares carrying not less than 50% of the voting power is held by one or more cooperative societies, they're also widely held companies. All listed companies are widely held companies, and companies in which more than 50% shares are held by either the government or a corporation which is established by the central, state or provincial act, or by a widely held company, or by a subsidiary of a widely held company, will be called a widely held company. And any company which does not satisfy this criteria will be a closely held company, even though it is a public limited company. So even a public limited company can also be a closely held company, because there are many public limited companies who do not fulfill the criteria which has been given for the widely held companies. Is the point clear? The difference between widely held and closely held companies, is it clear? Okay. Now, why this particular difference is important? Why income tax talks so much about substantially interested means is interested to a very great extent. Substantially means that to a very great extent the public is interested. Okay. Now, you would ask me that, ma'am, why Income Tax Act has made such a difference, which I discussed with you, I think, no, I did not discuss with you, I discussed with somebody else. Now, what happens that, supposing there is a partnership firm. In the partnership firm, when the partnership earns any profits and shares that profits with the partners, partners are not required to pay any tax on the share of profit that they get from the partnership firm. This I discussed with you in the last class, right? Partners are not required to pay any tax on the share of profit that they get from the partnership firm, right? But when we talk about a company, if there is a company and the company earns any profit and shares that profits with the shareholders, then in that situation, company pays dividend, right? When the company shares the profits with the shareholders, the company pays dividend. And when the company pays dividend, company is required to pay dividend distribution tax at the rate of effectively 19.995%, right? Now, if the partnership shares the profit with the partners, the partnership is neither the partnership nor the partners is required to pay any tax. But in case of a company, if the company shares the profits with the shareholders, company has to pay tax at the rate of 19.995%. Now, if it is going to be a closely held company, in a closely held company, because the public is not substantially interested, generally the major shareholders are the directors. So what they try to do, they try to take out money from the company, take out the profits from the company, but they do not want to pay dividend distribution tax. They want to take out the money from the company because, they consider it as the share that they have in the business, right? But they do not want to pay the dividend distribution tax. So in order to check that kind of practices, certain provisions have been made in the Income Tax Act. So how will they get the money from the company without declaring dividends? They will take the money as loans to directors. They can take the money out of the company as they can ask the company to pay make certain payments on their behalf. Right? So, there are certain provisions in the Income Tax Act to check out these kinds of transactions and to charge tax on these transactions. That is why the difference between closely held company and the widely held company is very important. Secondly, many a times what people used to do, they used to, in order to, what they would do, they would think that, if I become a shareholder in the company, it's very difficult, but I have to inject certain capital in the company. I have to inject capital in the company, but if I become a shareholder, then, and I take a loan from the company, it's going to be very difficult. And secondly, if I become a shareholder, then I have to disclose that I have taken these many shares in the company to a lot of authorities. So what people used to do in these closely held companies, they used to inject capital by way of share application money. And this share application money was never converted into share capital. Money was with the company, but the money is in the form of share application money. So the provisions have been made in the Income Tax Act to check out these kinds of transactions. Thirdly, what can happen is, because it is effectively a partnership firm given the shape of a company. So what can happen is that these people who are the owners of closely held companies, they can start a business in case they've got losses. In case of losses, what they will try to do, they will try to sell off the company to a profit-making company, so that the profit-making company can set off the losses. Right? Again, provisions have been made in the Income Tax Act to check out these kinds of practices. So what are these provisions which are applicable on closely held company? One more thing which I would add, and then I will give you the provisions. Fourth thing which was happening in case of certain foreign companies which were incorporated outside India, what they were doing, if they had any subsidiaries in India, and the foreign company was supposing in a tax haven like Mauritius, it's a Mauritius based company, supposing, having a subsidiary in India. Now, if the subsidiary declares a dividend, if the subsidiary earns profit, the subsidiary will have to, send the profit to the Mauritius-based company, the parent company. If the subsidiary declares dividend, the subsidiary has to pay dividend distribution tax. So what they were doing is, rather than paying dividend distribution tax, what they were doing, the parent company was buying back the shares of the subsidiary at a premium, and by way of this premium, the subsidiary was transferring the profits to the parent company. You would say that, ma'am, if the parent company was buying the shares at a premium, in that situation it would lead to a capital gain tax, isn't it? When I hope I'm able to to explain what I'm trying to say. Now, if it's a Mauritius-based company, if it has initially purchased shares in the subsidiary at ₹100, and the subsidiary and the parent company and the subsidiary buys back these shares at a price of say ₹400, in that situation definitely it leads to a capital gain of ₹300. But if a particular company is based, if an investment is coming from Mauritius in India, we've got a double taxation avoidance agreement with Mauritius, where we cannot charge capital gain tax. We cannot charge capital gain tax from a company which is coming out of Mauritius. Right? And this is because of a double taxation avoidance agreement. So by following this buying back procedure, the companies were avoiding payment of dividend distribution tax and transferring profits to the parent company without paying any taxes in India. So these were certain situations, these were certain problems, these are certain problems where certain manipulation is possible. Without payment of taxes, the closely held companies or the unlisted companies can transfer profits to the owners. You're getting my point? So what are the provisions in the Income Tax Act which have been made to counteract these kinds of situations? That is what I want to discuss with you. So what are the provisions in the Income Tax Act? The first is the provisions under section 222E of the Income Tax Act, which talks about deemed dividend. What does this provision say? This provision says that in case a closely held company gives any loans to the directors or makes any payments on behalf of the director, these loans to the directors will be deemed as dividend. And if they would be deemed as dividend, in that situation, even though the director returns this money back to the company, still it will be deemed as dividend, and the directors would be required to pay tax on this dividend amount that they're getting from the company in form of loans or in form of payments made on behalf of these directors by the companies. Right? So the section applicable is section 2, subsection 22, clause E. And this particular section is applicable only on closely held companies. Is the point clear? So a closely held company cannot give loans to directors and cannot make payments on behalf of directors, because if it does that, in that situation, these payments would be considered as deemed dividend and the directors would be required to pay tax on it. So one loophole has been clubbed this way. Is this point clear? Can I get some responses? Okay. The second provision which is there in the Income Tax Act is the second provision which is there in the Income Tax Act is section 79. Section 79 says that the business losses can be carried forward by a closely held company only in a situation where minimum 51% of the shareholders remain the same in the year in which you had the loss and in the year in which you want to set off those losses. So minimum 51% of the shareholders should remain the same. So this particular provision, in case of losses, the closely held companies cannot sell off the company to a profit-making company, because minimum 50% of the shareholders have to continue to remain to be the shareholders of the company till the time the company wants to set off the losses with the profits. Right? This is under section 79 of the Income Tax Act. Is it clear? Okay. Then coming to the next. Section 56(2) clause 7b states, where a company not being a company in which public are substantially interested receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of the shares, the aggregate consideration received for such shares as exceeds the fair market value of the shares. That means that if what was happening is, like, I'm coming to now this particular situation where people were injecting money in the company. Can I repeat section 79? Okay. See, section 79 has been added in the Income Tax Act. It is applicable only on companies in which public is not substantially interested. That means closely held companies. This section says that if you have a closely held company, supposing you incurred losses. Now, that does not mean that you can, because it's a small company, so generally what we can do is we will merge this small company into another company which is a profit-making company, so that the profit-making company can set off the losses of the of the loss-making company. Section 79 says that, okay, if you want to do that, you can continue to do that, subject to the condition that minimum 50% of the shareholders of the loss-making company should become the shareholders of the profit-making company, or minimum 51% of the shareholders if the company remains the same. If it does not merge, then in the year in which you've got the profits and the year in which you've got the losses, in both the years, minimum 51% of the shareholders should be common. Got my point? Okay. Now the next is a situation where the companies are either issuing shares at a price which is more than the fair market value of that particular share. I have got a company where if I look at the book value of the assets and if I look at the market value of the assets as well, the share price should not be more than, say, 25 rupees or 30 rupees. And if I am issuing the shares at a price of 100 rupees, in that situation, Section 56 says that if it is a company which is a closely held company, and if it is receiving any money from any person who is resident in India at a price which is more than the fair market value of the company's shares, in that situation, that differential, because it is generally the black money which comes into this kind of companies, that differential will be considered as the income of the company and will be charged to tax. Is it clear? Section 56(2)(b) says, 56(7)(b) says that in case anybody is buying shares of the company more than the fair market value of the company's share, in that situation, whatever is the higher price which is paid for that particular company's share, the differential will be considered as the income of the company in that particular year. Provision to Section 68 again was inserted in the year 2012, which says that in case there is a company, and this is a company which is a company in which public is not substantially interested, and any sum gets credited in this company as a share application money or share capital or share premium or any amount by whatever name called, and there is no explanation of this money. Like from where this money is coming, whose money is this? In that situation, the person who is where this particular explanation is not satisfactory, in that situation, that amount will be considered as the income of the closely held company. Now, these kinds of provisions have been made to check the black money being entered into the companies. Provision to Section 68 and Section 56(2)(7)(b) has been added in the year 2012 only in the Income Tax Act. Further, so these provisions are clear, they are applicable only on closely held companies. So you now understand why the difference between the closely held and the widely held company is important. Further, I would also be discussing with you, when I discussed with you the provisions of dividend distribution tax, at that point of time I would be discussing with you one Section 115 QA. Now this particular section says that if it is a closely held company or if it is an unlisted company, and if this unlisted company buys back the shares at a premium, in that situation, the difference between the price at which the company issued the shares and the price at which the company is buying back the share, on that particular differential amount, the company would be required to pay additional tax at the rate of 15% plus surcharge plus education cess, right? Under Section 115 QA of the Income Tax Act. So this is additional tax on premium on buyback of shares. On this Section 115 QA also, you had a question in the last examination, December 2015 examination. This is one section which I generally discuss when I discuss with you dividend distribution tax, right? Again, this section is also applicable only on closely held company. Why I brought it here as well? Because I wanted to tell you that why this definition of closely held company is important from the point of view of Income Tax Act, right? So various sections are applicable on closely held companies. Is it clear? Or is it getting too much? I am picking up sections from here and there and trying to put in one particular framework. It might be getting a little difficult for you. Clear but not too much, or is it too much? Clear but too much. Okay. So if it is becoming too much, then in that situation, because we are already at the end of the class, so I would not like to take it further. I'll close it here as well, here only, and I would be taking up the other classifications in the next class. Right, Sneha? So that you can even get some time to read through these provisions. And I generally suggest that on these kinds of provisions, it is generally advisable that you read certain articles. And there are a lot of articles which are available. So you can simply write on Google that, buyback of shares, articles and all that. Deemed dividend, can I explain once again? Surely. See, I said that if it is a closely held company, and the closely held company, if it declares dividend, in that situation, it would be required to pay dividend distribution tax. So as a general practice, and this also happens in case of in case you and me, we start a business and, if I've got a routine, certain requirements. So what we do in partnership, we say that you can take certain drawings from the partnership firm. But in company form of a structure, that kind of drawings concept is not there. But still, as businessmen, as they are, they still withdraw a certain amount from the company for their day-to-day requirements, or they take loan from the company. Now, those kind of transactions, if we do it in the company form of a business organization, they are considered as loans to directors. And in that situation, Section 2, subsection 22, clause E says that in case of a closely held company, if a loan is given to a director who is holding more than 10% of the shares of the company, that particular loan will be considered as dividend. And the director would be required to pay tax on that amount, which it has taken as a loan from company. That is why it is called deemed dividend, because otherwise if you look at it, it is not dividend. I have taken a loan from company, which I am going to return back also. But Income Tax Act considers it as dividend. That is why it is called deemed dividend. Right? So with this, we close the discussion for today, and we continue with this particular concept of companies under Income Tax Act, and we also start with minimum alternate tax in the next class. So you've got a full week to study. You can study what we have discussed so far. You can also study certain articles on deemed dividend. You can study certain articles on Section 79. You can study certain articles on Section 115 QA, on on these share application money and share premium account in the closely held companies, and that